This perhaps brings us to another interesting point about our process, which is how we think about valuation and the probabilistic nature of that, and how that enables us not just to buy but also to sell, because whilst we want to own a business forever, we don't always own a business forever. We're in the public markets, so we take advantage of it. Perhaps I should quickly just describe what probabilistic valuation is to us, and then maybe after I've done that, Aziz, you could sort of tell us about some of the benefits that you especially get about that as a portfolio manager. So we don't try and say, okay, we think revenue growth is going to be 4%. We start by thinking, okay, what can it not be? What's the most it can be? Because it's a lot easier. Trying to sort of actually, work out what growth is going to be is very difficult. It's much easier to start with actually, it can't be more than 12% because that would imply X, Y, and Z. You can work that out with quite a degree of certainty. Equally, you can work out the lower side. And then you can start to narrow down. So it makes it much easier for us to build forecasts by doing that. But then once we've done that, once we've got our 4 key inputs, we look at what's the historical correlation going to be. And that's just mechanical. It's there in black and white. What has margin done compared to revenue? Because some businesses are pro-cyclical. Revenues go up and margins increase as a result. Great. But other businesses work the other way. The only way you can drive further growth is by increasing your sales and marketing. So if you're a Unilever of the world, you're only going to increase your growth by spending more on advertising. Well, that's going to hurt your margin. But equally, the opposite, if you're a chemical company, if your revenues go down, if your volumes go down, your utilization goes down, therefore your margin goes down. So they're positively correlated. So what that means is when we simulate it, we will get a really good idea of what the valuation distribution is. And we get a chart that plots, what is at the 25th percentile, what is at the 50th percentile, what is at the 75th percentile. And maybe now, Aziz, what benefit does that have to you as a portfolio manager?
Yeah, I think one of the key things about being a portfolio manager is you have the option, not the obligation, but you have the option to change how much you own of something at any moment in time. And the reason I think it's a useful option to have is at different points in time, either at an individual position level or a portfolio level, there might be a better place for the incremental dollar that you invest. And let me explain this a bit more. So let's first think about an individual opportunity. You mentioned Unilever. Well, the first thing is I have to ask myself a question: is it worth buying? And one of the things that we talk about is we need to buy a great business. We want it to be a great company, and we want to buy it at great value that gives us a margin of safety. So the first question is, what margin of safety am I going to demand for Unilever before I'm willing to put the first dollar into Unilever? And I can ask the same question about Unilever, and I can ask it about a chemicals company. And there is no way that the amount of margin of safety that I demand from a chemicals company is going to be the same as the margin of safety, the discount that I would require for investing in Unilever. Unilever is a lot safer. The range of uncertainty is a lot smaller. The downside is a lot lower. And so a 15-20% margin of safety is probably a great margin of safety for something like a Unilever. It's a terrible margin of safety for a chemicals company. So that's the first thing, kind of in looking at opportunities to initiate.
So if you were to just say a 20% margin of safety is what you want, you're then going to buy chemicals businesses that are actually too risky, and you're never going to buy the Unilevers.
Absolutely. So I think that's the first thing, when comparing opportunities, knowing what the margin of safety required is. The second thing is deciding how much to own. So I always think about, when we talk about great business, great company, great value, the first two determine whether to own something, and the last one determines how much to own of something. And so depending on, if I have a distribution of value and I look at all the scenarios that could happen in the future, and in 90% of those scenarios, we make money, then I could put 5% of the portfolio in it. But if it goes up in price next month, and now 50% of the scenarios, we make money and 50% we don't make money, well, surely, if it was a 5% position last month, it should be a lot less this month, holding everything else equal in the portfolio and the world. And so the other thing that a probabilistic valuation gives me is this ability to change how much we own of something, not just whether we own it. And we talk a lot about being long-term investors, and there are many things in the portfolio. They're literally the things that we've owned for more than 20 years. But the things that we've owned for 20 years, we've had at some times 1% in that name, and in other times 9% in that name, depending on how the valuation looks like. And then the third thing that I think a probabilistic valuation gives us is this forward view of essentially what kind of IRR you should expect. And you take that IRR and you combine it with essentially the distribution of outcomes, and you effectively end up with a risk-adjusted IRR. And then you ask yourself, or I ask myself as a portfolio manager, okay, I've got this additional dollar that I might deploy. I've got opportunity A, where the risk-adjusted IRR is X. I've got opportunity B, where the risk-adjusted IRR is Y. Or I've got opportunity C, which most people don't think about, is I don't deploy the dollar, but I buy myself the option of deploying this dollar next month in a different opportunity, or when the market comes down in the same opportunity at a higher risk-adjusted return. And so there's always these three questions that are, the three options that we have to compare.
So the point is, if we look at two stocks that both have 30% upside, actually, then they don't have to be equal.
No.
One can have much more downside than the other.
Yeah, I mean, you and I've had this discussion before. People ask, "Oh, what's your favorite stock in the portfolio?" And I'd say X, Y, Z, and like, why isn't it your top holding? And I'm like, because it's not the best risk-adjusted return. There are things, if you look at their top holdings, like Unilever or Nestle, they're not the ones that are going to produce the highest absolute return. They're just great risk-adjusted returns at this moment of the market cycle, given everything else that we own and everything else that we could own in today's market. And so sometimes number 12, which may not even, is actually the one that's going to produce the highest return. It's just risky, and so we're not going to put too much money in it.